Hi, Barbara Friedberg here from Barbara Friedberg Personal Finance, here to talk to you today about low risk investing. Low risk investing is kind of a misnomer because there is a certain degree of risk embedded within investing and actually within life as well. Now, it's unlikely that you will break your leg or get run over by a car through investing. So you can kind of cross those risks off. But then there are other types of risk when you invest. And we're going to get into those. We're going to talk to you about 7 different types of investments and their degree of risk. And you can decide for yourself which ones will work for you and which ones have too much risk. So let's get started. We'll talk about what is investment risk. We'll discuss the difference between a high and a low risk portfolio, and then get into the various different types of investments and discuss their risk properties. So, investment risk comes in a lot of different flavors. Now, the simplest risk of investing is the potential loss of principal. You invest $100 in the stock market, and in a year, the stock market takes a tumble of 20%, and you only have $80. That's pretty scary. But on the other hand, the stock market tends to go up more frequently than it tends to go down. And if you stay invested over a long period of time, it's likely that your investments will ultimately go up. Now, there's another risk within investing, and that is inflation risk. And we all know what inflation is. It's when your $10 will buy less today than it used to purchase in the past. So think of your McDonald's meal. You used to be able to go to McDonald's and get a nice little meal for $10. Today, that same meal costs you $15. That's inflation. And you want to consider inflation risk as well. So how do we understand the relationship between risk and investing, and what types of investments have what types of risk? We're going to look at one of my favorite charts, and please bear with me because I know it looks a little bit messy, but don't worry, I'll go through it with you. The blue line represents the S&P 500, which represents the stock market. And we're looking at a graph from 1928 to 2023. So it's a really long time. And this shows the volatility of the overall stock market. And this is the price volatility. Now, returns have been, since this time, average annual returns on the stock market have been like 9% per year if you average them out. But this year, in 2008, they were not 9%. In fact, the stock market went down nearly 30%. And again, look at this year here, 1970, looks like 5. Stock market again went down about 25%. So this is what you need to be prepared for if you are invested in the stock market. Here's 2022. It went down nearly 20% that year too. So you need to grasp that over the long term, stocks have delivered 9 to 10%. Now, are they going to deliver that type of return going forward? I don't know. Neither do you. But what drives those returns is growing U.S. and global companies. So if you anticipate companies are going to continue to grow in the future, you can anticipate that your stock portfolio will also increase in value. Okay, so if you look on a year-to-year basis, for example, 1 to 5 years, stocks are super, super risky because you could lose a lot of money in that short term. But if you look over long periods of time, not so risky. It's likely if you're saving for retirement in the stock market, you're going to build up a nice portfolio. Okay, then we have, let's just go to our 3-month treasury bills. And you can think of those as like your high yield money market account, your cash equivalents, your CDs. Now, they don't vary much in price. They pretty much stay around the same price. That's the gray line. And you'll see they don't deviate much from their purchase price. In other words, if you buy a CD today for 1 year, paying 5% per year, at the end of that year, you will get, for $100, you'll have $105 in your account. Your original $100 plus your 5% interest. That's great. That's wonderful. Unless inflation is 6 or 7%, and then you've lost 2% of purchasing power. So those types of investments, cash type investments, are good for short-term needs. You get a little cash and the money's going to be there when you need it. So if you're saving for a down payment on a house, a vacation, your emergency funds, renovation of your house, you want to keep that money in cash type investments because you want to protect the principal. And even if you lose a little bit of money to inflation, it's a heck of a lot better than losing 20% because the stock market tanked 1 year after you invested. Now, bonds are a little different, and bonds are like a loan to a government, and they fall between stocks and cash in volatility. You can see the orange line is the return on the average corporate bond over time. And they also pay over time, usually about an average 5% yield. And if you hold a bond till maturity, you'll get your original principal price back. And if you hold a bond fund for the long term, it'll be pretty much similar to holding individual bonds. And you should get, over many years, your average coupon value of a 5% average return. But in the short term, bonds can be kind of risky. And over the past few years, bond values have really tanked because interest rates have gone up and bond values trend opposite or inverse to interest rates. Whew, that's a lot, I know. But now you have an idea of how risk is considered when you're in investing. So let's get on to the real meat of this conversation and talk about the differing low risk investment options. And first, we will start out with those monies that you're going to need within the next 5 years. So U.S. Treasury inflation, and you want to protect your principal from inflation. And none of these investments are perfect. And none of them are going to follow exactly how they've trended over the past. But we approximate future returns based on our expectations and our history of the past. So U.S. inflation protected securities like TIPS and I bonds are designed by the Treasury Direct, which is the government, to protect your principal from cash. And they promise to deliver a return that will keep your money principal equivalent to the purchasing power. So, for example, with an I bond, if inflation goes up 3%, then your coupon payment or your interest payment will also go up 3%. So your $100 I bond will return $103. Tips work a little differently. You can check out this article here, and I'll put a link to the show notes into that article as well and find out how they work. And Treasury inflation protected securities are great if you just want to keep your principals safe. Okay. I don't know how we got to number 3 without doing number 1 and 2, but we'll go back to number 1 because a high yield bank savings account is super easy to invest in. You first of all search online for high yield bank savings account. Right now they're paying about 4.5 or 5%. I personally like that you can get a really high yield savings account at Wealthfront and M1 Finance. They're paying in the neighborhood of 5% right now. And I've got links in the article and I'll put those below. And we will possibly get an affiliate commission if you sign up through those links, although maybe not. It just all depends how the company's plan is working at the time. But I do need to let you know that. And again, you don't have to use those links if you don't want to. So pretty much how a high yield savings account works is that you put your money in, you put $100 in. If it's paying 5%, then you get the equivalent to $105 after a year. You're not going to lose the $100. The only risk you have there is if inflation is higher than 5% and the account's paying 5%, you're going to lose a little purchasing power. Now, similar to high yield savings account are bank or brokered certificates of deposit. And you lock your money up for a period of time, 3 months, 6 months, a year, 2 years, 5 years, and you will get a pre-decided interest rate. Now, if you take your money out early, let's say you buy a 5-year CD paying, say, 4.85%, if you realize you need some of that cash out early, you might have to sacrifice a quarter of interest rates. Not a big penalty. These type of investments are great for your short-term cash needs. They'll give you a really good yield. Right now, that could change when interest rates change, obviously, but your principal is going to be protected for whatever you might need it for the next several years. We already discussed these. Okay, so now we're thinking retirement. And we're crafting a long-term portfolio. And low risk when you're investing for retirement means something totally different than it does if you're investing for the short term. And retirement investing means, are you going to run out of money before you expire? And you do not want that to happen. You want your money to last you through your entire life and hopefully have a little left for your heirs, your kids, your charities, whatever you want to invest in. Bond exchange traded funds or individual bonds. These funds own only bonds, which are loans to companies, to governments, whatever. They pay a set interest rate and their price will vary, as we saw on this chart here. Their prices vary. Typically, they do not go up and down in value as much as your stock funds do. So they're a little bit less volatile in price, and consequently, they deliver a little bit lower interest rate. And there's so many different types. There's different maturities, and maturity is virtually, short term, say 6 months to 1 year to 2 years, to long term to 10-year bonds. And they're important to hold in a diversified portfolio for several reasons. And they will be considered lower risk or lower volatility than your stock investments. And so consider bond ETFs as a part of an overall stock and bond diversified investment portfolio. They typically do not move in the same direction as stocks, although in 2022 we had an unusual situation where both bond funds and stock funds went down. That does not usually happen. And you can kind of bolster up your returns if stocks take a dive. Bond funds typically will not take as much of a dive. And it's been found that a 40% bond, 60% stock fund delivers nearly as good a long-term return. And long-term, we say 10 plus years, as does an all stock portfolio. Okay, now here we're going up the volatility level, which means more ups and downs in price. High dividend stock funds are typically a little less volatile than your most aggressive stock funds, which are your growth stocks. And these will pay you a dividend, and they will also deliver capital appreciation and growth. Over the long term, you might consider these less riskier than a growth stock fund, but a high dividend stock fund is not a good idea for any money that you need within the next 3 to 5 years because their values go up and down. Real estate, another high yielding investment, a little bit less risky than stocks, and again, can be part of a diversified portfolio, great for your retirement investing, should be held probably in a retirement account, an IRA or a 401k or 403b, because they pay higher dividends and they are taxed as the dividends are taxed as ordinary income. But over the long term, they've delivered a good 5 to 7% capital appreciation, along with some robust 3 to 4% dividends. Again, lower risk for long-term investing, retirement, college planning 15 years ahead. And then our final, what we consider low-ish risk investment, are target date funds. And a lot of retirement plans offer these. And how they work is they are a combination of both stocks and bonds, and they are geared for those who are planning to retire at a certain date. So if you're 50 today, you're retiring at age 60, it's 2024, you'll look for a target date fund that is 2034. And what that means is they'll bulk up. They have stocks and bonds, and as you get closer to your retirement date, you'll have fewer stock funds and greater proportion to less volatile bonds and cash assets, so that by the time you reach your retirement age, you can start withdrawing from these funds and hopefully be confident that the funds will be less volatile during your deacquisition stages. Now we have a bunch of frequently asked questions, which you can read on your own as I list in the disclosures below, a link to this article. So to sum it up, low risk investing for short-term investments is really quite clear. Go with a high yield bank savings account, bank or brokered CDs, certificates of deposit. We like Wealthfront and M1 Finance because they do offer really attractive high yield savings accounts. You can also get these at your bank. Over the long haul for retirement goals that are 15 to 20 years away, it's really lower risk to be invested in stocks and bonds because that will help to make sure that you do reach your retirement goals and earn enough money to finance your retirement when you stop working. Thanks for stopping by. I love comments. Please comment with your questions below. And I will put links below to this article, other related articles and videos, and I will see you next time. And remember, if you do sign up for a link that is labeled affiliate, our company might get a small cash payment to help finance this fund. To finance this channel. See you next time. Bye.